Many people today are losing money because of typical financial planning. Even people who think they're saving enough money right now are finding out that fees, taxes, volatility, market volatility that is, and inflation are taking their money away from them. And it's taking away the money that they are counting on. So it's not that hard to build wealth today, but the financial system in America is not designed to make you rich. It's designed to make banks rich, it's designed to make the government rich, and it's designed to make Wall Street rich. All we have to do to build our own wealth is use a financial formula that works, and that's what we're going to be covering this morning. I have this little example up here that I would like to share with you. Who's heard it said that compound interest is the eighth wonder of the world? Have you heard that before? Okay. It's amazing. I want to share this with you because this is what $100,000 looks like in this example. All of this water is measured out specifically to represent money to scale. And this is what $100,000 look like. In other words, this is the scale for the whole example we're about to look at. Okay? So if you need to know what scale looks like, just know that's $100,000. Now, if you take $100,000 and you just put it into an account that is earning 6%, and that 6% is compounding, then at the end of 30 years, this is how much money you would have. This is $574,000. That's earning 6%. Now, there's a reason I chose 6% for the example, and the reason is because the average investor today believes that they could return about 6%. If you Google it, that's the figure you'll come up with. So just picture this. You put $100,000 away today. 30 years from now, you have over $500,000, $574,000. But it's not quite that simple. Remember, I said that the financial system in America today is not designed to make you rich. The first thing that comes out of here is going to be if you are investing, the standard investment account today, under $1 million, has a 1% management fee on it. Just 1%. Doesn't sound like it's all that bad. And since this account is under $1 million, 1% will be the fee. So let's pour off the money that would go to fees or be lost because you're paying fees on this as you go along. $150,000 lost to 1% fee. Okay, now that's over 30 years. $150,000, you still have a bit of money in your investment account. That's okay. But we've also got to give Uncle Sam his cut. Remember, the financial system in America today is designed to make Wall Street, that's the money managers, and the government rich. And so let's do 24% tax bracket. That's a kind of a middle of the road tax bracket for somebody who can put away $100,000. And we find out that because of taxes, you'll lose $123,000 of that growth. Now, some of you might be looking at this already and saying, wait a second, why is 24% in tax less than 1% in management fee? I thought 24% was more than 1%. Well, it is, but you have to understand that 1% comes off your entire account value every single year. 24% tax is only on the growth that money has in that year. And so what we find is that even though 1% sounds like a small, tiny little fee, it can steal more wealth from you than 24% tax bracket. This is $123,000. The fee is $150,000. And so you get down the road 30 years from now, and you've been earning 6%, but it sure doesn't feel like it because you don't have $574,000, do you? Well, the truth of the matter is, I hate to break it to you. When you put $100,000 away 30 years ago, it would buy a whole lot more than $100,000 will now. Inflation. And so let's adjust for inflation really quick and see how much purchasing power you really have. I'm using a 2.8% inflation rate. And I'm using that rate because I just typed into Google, what's inflation rate? And it said 2.8%. A lot of people think it's 3 or somewhere between 3 and 4 in actuality, but we'll just figure 2.8 for this example. And we find out that by far, inflation is the biggest theft of your wealth. Look at that. More than 1% fee, more than 24% tax rate. That's $173,000 that was just stolen by inflation. It evaporated. And so let's go evaluate your account now. This doesn't look as nice as it did a moment ago, does it? It's a far cry from $574,000. In fact, it is only $129,000. That means by putting this $100,000 away 30 years ago, you have a little bit more. That's less than $1,000 more per year of your investment. That's less than $84 a month that you earned. Now, if you had done this, if you had put this money away and you woke up 30 years later to find out you only had $129,000 of purchasing power, would it bother you a little bit that because your money manager was charging you a 1% fee, he was able to steal more wealth from you than what you ended up with? It does. I can't say it better than that. $29,000 is all you came ahead, but you lost $150,000 because remember, $100,000 of this was already your money. This is typical financial planning in America today. This is what you're supposed to be doing. And let's just realize that we assumed a 6% average return. How many people do you know that are getting 6% average right now? Another important question. Everybody knows how to make $1 million in the stock market, right? You start with 2 million. That's the state of things today. And so one more thing before we get to what do we do about all this? Because most people are going about their finances completely backwards, upside down. Let me show you what I mean. The ideal financial picture should start with a good foundation. And the ideal way to do it is to start with protection. And then once you have protection in place, you should have a good, solid way to save money. Once you're keeping more of the money that you make, then you can look at managing your debt. Some debt is good debt if it gives you tax advantages, if it gives you cash flow increases, or allows you to leverage money to make money. Some debt is bad debt. By managing debt, we're managing the good debt, and we're getting rid of the bad debt. And then finally, once you have this in place, that's when you can move on to investing. We like to start with safer investments. Investments, if you're in business, can be investments into your business. That's relatively safe. You can believe you can turn a profit, you will pay yourself back. And then if you want to go on to higher risk investments, that's the time to do it. Higher risk investments might be things like this, where you could earn potentially more, but there's also big risk of loss. But here's what most people are doing today. They go for the shiny thing, the investment, where they have the potential of making the most. Well, they also have the potential of losing the most, but they focus on the earnings. Let's be positive, man. So they start their financial foundation with that. Okay? Now, oftentimes, those don't turn out as well as they were hoping. Because, whatever reason, their profits are not coming in like they expected. And so they say, well, I need to be a little bit more conservative with my portfolio. And so they'll go to a more conservative option, which is lower risk. Okay? And their thinking is that my investments will eventually return enough money that I can pay off all my debt. Some people even go into debt to do this, the investment part. And they're hoping their investments will pay off the debt portion, okay? And then they say, once my debt is all paid off and my investments still return, then I will be able to save money. And if it all works out this way, they're to this point and they go, oh my, better protect this so I don't lose it. Well, the economy is not stable. Nobody knows how these investments are going to react. And since they're on the bottom, they're going to change the whole stack. So let's just make the economy change a little bit here. Oops. What are the first things to go? Protection and savings. Now, all they have left is debt and underperforming investments, if there's anything left of them. Have you seen this happen to people you know? Yeah, this is typical financial planning in America today. It's a problem. People are losing money, but we have a formula that we teach people, a slow and steady way to keep more of the money they make so they can grow their wealth and have financial peace of mind. Would anybody like to know what that is? Please help me welcome my dad up here. He's going to share that with you.
Will Rogers, American's cowboy, said years ago, it's not what people don't know, it's what people think they know that just ain't true. And so let's just expound on a little bit of what people think they know today, because typical financial planning thinks they know a lot, but traditionally, that's not the way America became what it was. Traditionally, it was built on very solid, legal binding contracts. And typical financial planning is not based on contracts. It's based on speculation and hope. Okay? So government has placed the responsibility for retirement back on the American citizen. In the past, there were pension plans that were sponsored by employers and government and things like that. And the government was supposed to oversee these plans. Now, maybe they were good and maybe they weren't, because a lot of these pension plans were underfunded. But long before even pension plans came, Americans realized that who's the most important person in the room? I am. And if I and you are, and if you don't take care of yourself, then you're not going to be taken care of like you want to be taken care of. Nobody will take care of us, you, me, the way that we will take care of ourselves. And so American was built, as Benjamin Franklin used to tell the Europeans when they said, oh, I want to come to America. He says, everybody works in America. Because they didn't have this class of people that supported everybody. So America was built on something that was very strong, independence, that we took care of ourselves. And so that's the traditional method. So government now has put that responsibility back on us by getting rid of most of the pension plans and having contribution plans. And so what has that led to? That's led to, by eliminating, we are now dependent on 401ks, IRAs, IRAs, TSAs, and things like that. Obviously, individuals have not lived up to their responsibility because many people have failed to keep enough money to be able to retire uncomfortably. Let's look at some of those statistics. According to Fidelity, there are now 441 millionaires out there that became millionaires because of their 401k. Now, you think, wow, that's a great number. That's awesome. By the way, I just pulled this number. This just happened last month. Last year, there were only 200,000 of these people. So it's growing, and that could be a good thing. Let's find out, okay? The median balance, now, does everyone know what a median balance is? That means 50% of the people are below it and 50% are above it. So Fidelity says that 50% of the people 60 to 69 years old have less than $63,000 in their 401k. Is that a good picture? And only 50% of them have more than that. I'll tell you, if the median is at 63,000, that 441,000 people is a very, very small number to get that median number. In fact, the average balance dropped by 1% in 2019, even though people were saving more than 4%. For those who have hit the $1 million mark in their 401k, it's because they've contributed more than 20% of their income. Not very many people can afford to do that. So we're talking about the very, very top crust of people that can still put money in a 401k legally. According to Megan Murphy, that may not be the best thing for them because it puts them at risk. How could having $1 million in your 401k put you at risk? That's the question. But that's the question that typical financial planning has put a lot of people into. How is your 401k money at risk? How is your IRA money at risk? According to the Social Security Administration, all senior citizens that are taking Social Security today, 50% of married couples and 70% of unmarried couples are receiving more than 50% or around 50% of their income from Social Security. I mean, we're the richest nation in the world. Why is that happening? And when you think that the average Social Security check is less than $1,400 a month, that's not a lot of money, is it? 21% of married couples and 45% of unmarried couples rely on Social Security for more than 90% of their income. As of 2019, U.S. News reported that the average IRA balance for those 60 to 64 was a mere $165,000. How long does $165,000 last in retirement? Not very long. Vanguard said in the Washington Post that 55,900 IRAs are millionaires, millionaire IRAs. Out of the 13 million who participate, that's only about 4.3% of the population. According to Bloomberg, his news, not him, 65-year-olds had enough savings to cover just 9.7 years in their retirement. That leaves men running out of money 8.3 years before they die, and women running out of money 10.9 years because women live longer statistically. This is a sad picture. This is something that is really grievous to run into people that are, getting in line at the grocery store and barely wanting to know what they're going to be able to buy their food for. So what's at risk? What was Fidelity telling us that 401k millionaires and IRA millionaires are at risk? What is the risk? This is one of the risks, bear markets. A bear market is defined that the stock market drops more than 20% and stays that way for a certain period of time. So let's look back over my lifetime. I was born in 1960, and let's see the bear markets that we have seen in my lifetime. This was the first one. It lasted 197 days. This was the second one. I was 6 years old. It lasted almost 3/4 of a year. That's a long time. This one happened when I was 10, from 8 to 10. This one, I was out of high school at this time. This one, I was starting college, finishing college, starting practice. And so we see these bear markets and how long they lasted. Now, this is really interesting because when you lose 50% of your investment, it takes 100% return to get back to breaking even. When you look at how long this bear market lasted, now we've got to figure out, how many more years is it going to be before I break even? I remember Walter Updegrave wrote in CNN when the 2008 market crash happened. He says, don't worry. He says, all you have to do is earn 12% from now for the next 12 years, and you'll be right back where you started from. Liar. You won't be back where you started from. You lost 10 years. And Ben just told you what inflation does to money in 10 years. You've got to make more than that to break even. And this is why typical financial planning is so dangerous to trust with your future. Let's look at what the last 20 years of the S&P 500 has done. I know these numbers are small, but I took this off their webpage that we can check. So we wrote the numbers down below here. The average return over the last 20 years, if you had bought December 1st, 1999, and held till January 1st, 2020, you would have made 4.249%. With dividends being reinvested, you would have made just slightly over 6.2. That's historical data. Let's take it now and use inflation, because that's something that's the big elephant in the room that we have to address. And when we calculate and adjust for inflation, that means you made between 2% and 4%. Now, we've been in a really bull market for the last 3 years, maybe 4. And this is what we're getting. How long does it take to recover from that 57% loss in 2008? It's scary. It's scary. According to a survey from TD Ameritrade, 37% of people don't believe they pay any 401k fees. I hear some chuckles. Okay? 22% didn't know about fees. 14% said they didn't understand how to determine what fees they paid. Yet 95% of participants in 401ks pay fees. I remember a client called me one day. He says, well, my Morgan Stanley guy says, I don't pay any fees. I said, send over your prospectus. No, the manager didn't charge a fee, but every time that portfolio changed, there was a fee. And it ended up that he was paying about 2.5% average. Because they hide these fees. They don't want you to know. They want you to think all this money is yours until the time comes that you got to distribute it. Now, you might think that I'm against 401ks for the way I'm talking, but remember Ben's example up here. Let's get the base first. Some of this can come later, but we have to make sure that what we've got, we're protecting. Because if we don't have a solid foundation, then we're going to be subject to the things that are happening here. So a recent study showed that the average individual that has a 401k is paying about a 2.22% fee. And that includes all the management fees, all the trading fees, all the charges and everything. All right? So let's take someone earning 7%, which is what a lot of typical financial planners shoot for and say they can get. And let's start this guy out having $25,000. And let's let him contribute $10,000 to this investment for the next 40 years. Let's see what happens with these fees. Here's your fee. If it's a 1.5% fee, over the course of these 40 years, you will lose $791,000 on a 1.5% fee with that investment. On a 2% fee, you'll lose almost $1 million, almost 42%. On a 2.5% fee, you'll lose $1.1 million, or almost half of what you made. Now, we saw this played out right up here, didn't we? But this puts a little bit more reality. We used to do something called, kind of like Jay Leno did, Man on the Street. Remember Jay Leno? And he would go out on the street and talk to people. We used to do that, and we'd go out to people, and we'd ask them about their 401k. We did it right down here on the Strip. We did it in Portland one time. And it was really cool. This one guy said, well, I really don't mind paying a fee as long as it's not a whole boatload of fees. And he thought a 2% fee would be pretty good. Well, $1 million is a boatload of money, don't you think? Who worked for that money? Who took the risk for it? And especially when you think some of these 401k managers, they're not really manage it when you look into it, okay? In fact, Michelle just wrote an article, really fascinating article, that a group of monkeys throwing darts at a dartboard outperformed some of these managers, okay? Or a cat picking out the toy that he wanted to play with that day did a better job. And there was other things like that. So these managers are getting a fee, but what are they really doing for you? All right? Now let's take what's left over. If we used a 1.5% fee, which is below the average, because the average is 2.22, and let's just take that investment that we did on the last slide, and let's say you're retired now at 65. According to Bankrate, they'll give you money to live for 22 years. That'll get you up to 87. My dad died at 89. My mom's still alive at 82. The thing is 92. Population over 90 has tripled since 1980. Remember, men run out of money before they die by almost 10 years, and women, it's more than 10 years. because we're living longer, and medical expenses are rising, and fees are taking our money, and inflation is destroying it. And of course, we've got the tax situation, but you can talk to Campbell and Jones about that, okay? Another risk. This is something that I was taught by my parents to do, is to pay off your house as soon as possible. And I did. We paid our first house off in 5 years. We bought our second house by paying cash because I didn't want to owe anybody anything. Okay? In hindsight, as I look back over the 4 houses that we have bought and sold, we made about $350,000 doing that. If I would have done what I know now, I would have had over $1.1 million. Same cash flow, no change. Would you like to know what it is? Okay, we'll get there. All right? Historically, between 1890 and 1990, the actual rate of return on owning a home has virtually been non-existent. I didn't say that. Robert Shiller, the Nobel Prize winner in economics, professor at Yale, said that. The U.S. Bureau of Labor and Statistics matches it. Prices for houses were 113.69 greater in 2019 than they were in 1989. That's a 30-year period of time. So a house that was $500,000 in 1989 would sell for $1,068,451 last year. At that rate, you can earn a 1.4% rate of return and make more money. Many people have said your home is not an investment. And I will say this, it's an emotional investment. If you want to buy a home, great. We're buying our house, it's great. Michelle likes to decorate it. I like to work in the yard. You can't do that with rental property as easy as you can with your own. But realize there's a cost to that. It's not going to make you wealthy. Owning real estate to rent and to manage is a different story. But owning your own home is not an asset, it's a liability because of what we're going to talk about next. A $500,000 home at 4% for 30 years is going to cost you about $29,000 a year. Okay? However, according to Bankrate, you talk about insurance, maintenance, and the other things, property taxes and things like that, you're going to pay another $18,495 on an average home. Average home is $350,000, not $500,000, so we're underestimating this. All right? You add those two together, that's $47,000 a year, or almost $4,000 a month. Okay? That makes that cost of that home for $1,422,000 over a 30-year period of time. Remember the statistic on the last slide. In 30 years, that house really would have only gone up to $1.68 million, okay? Not $1.422. So that means you lost about $353,000 on this house. Now, don't get me wrong. I love our home. We're buying it, but I'm not paying it off early this time like I did our other houses because I want to be able to use that money to create more money, and that's part of the life benefits formula that we teach people, okay? Realizing that the magnitude of gains is nearly irrelevant when compared to the losses suffered due to market corrections is one of the first things that we have to understand. After a 50% drop in stock prices, it requires a 100% rise for you to break even. This makes 10 to 50% rises in stock prices much less consequential than a 30% drop. Does that make sense to everyone? You must always think of your downside potential as a series of losses. Those losses, those bear markets that we looked at, okay? Can you imagine, just imagine this for a second. You're getting ready to retire and another 2008 happens. What does that make you do? That makes you reduce your lifestyle or go hand out samples at Costco, right? Or flip burger. You got to get back in the workforce, and you weren't expecting to do that. Or what about some friends of ours who told me, hey, I got enough money to retire on, no problems. Within months, his daughter separated from her husband, and her 5 children came to live with him. We got a lot of boomerang kids and grandkids coming. We don't know what's going to happen. Or what about the client who was set for life with a GM pension and health care, and the government reassessed his pension plan, and the vice president signed on to it, and now he lost his health insurance. His wife died because of it, and he died shortly after. You see, we don't know the future, and so we've got to be able to be in more control of it than letting other people manage our money, like typical financial planning tells us to do. Better to maintain a modest appreciation annually over a 34 to 40-year period than to assume higher risk. Now, let's just talk about risk here, because the first thing that you're going to do when you see a typical financial planner is they're going to assign you a risk category. You're either going to be high risk, medium risk, or low risk. The older you get, the lower the risk you have, because they're trying to protect what you have. When you're young, they say, oh, you're high risk because you have all this time to make it up if something happens. And we're going to address that just before we finish this session this morning. So keep that in mind. Just because you're young doesn't mean that you're in a high-risk category. In fact is, statistics now prove that the people that were hurt the worst in the 2008 debacle were young people, because they lost everything and they had to start over. Okay? Be highly cognizant of the black swan events that occur randomly and can wipe out years of growth instantaneously. A black swan is an event that comes along that nobody predicted. Nassim Taleb talks about it in his book called The Black Swan, where Europeans went to Australia, and for the first time in their life, they saw a black swan. And they saw, this could never happen. The swans are white, right? And yet, they happen. And when they happen, this is what happens. Over the last 50 years, the majority of gains, up to 50% of them in some of the statistics I've read, have occurred in just 10 days in the stock market. 10 days out of the last 50 years. Can your typical financial planner pick those 10 days for you? This is so important. This is the first step of the financial formula that we teach. George Gilder, a great economist, said this: wealth is the product of hard work. We get so many people coming to us and just want to get rich quick and not have to do anything. A lot of people want to come to us and say, well, how can I avoid paying taxes? Hey, you live in the greatest country in the world. Be proud you can pay your taxes. Okay? You shouldn't pay any more than you have to, but you should be proud because it makes our country strong. Okay? We need to respect other people. There's a lot of people that get really, really rich, but they've done it by taking advantage of other people. They don't have mutual respect for others. They can't even enjoy their wealth. All right? And finally, wealth can only increase when the people who made it control it. This is so different than what we're hearing today, in that what is mine and what is yours is mine too. It doesn't work that way, because if you take what's mine, then my incentive to even produce goes away, and pretty soon you won't have anything either. Okay? So this is the basis of what we start teaching people. Now, we use something called whole life insurance, which is a traditional financial planning tool. And most typical financial planners laugh when they hear this. But let me just show you something. Remember that house that you paid $144,000 for? If you put that in life insurance, you'd have a guaranteed gain of $458,000 in 30 years. 548. I'm sorry. Thanks, John. You would have a potential gain of over $1 million. Plus, you would have a death benefit to pass on so the next generation doesn't have to pull themselves completely up by their bootstraps. Or you can choose to buy your house and lose $353,000. That's what I did for 4 houses until I caught on. All right? Now, if we come down here to year 16, there's $734,000 that's guaranteed in that policy. So a lot of people say, well, try to pay your house off as fast as you can, put extra payments in it and everything. And what we know is that if you'll take that extra payment and buy life insurance with it, instead of putting it toward the mortgage bank and making the mortgage banks richer, in year 16, you'll have enough money in this policy that you could pay your house off early. And then you could take your own sweet time about paying that back to yourself while the policy still grew and made these kind of gains for you. So this is what America's foundation was built on. Benjamin Franklin was the first person ever to introduce life insurance into this country. Shortly after that, the Presbyterian Synod introduced it to take care of their pastors and their lay pastors because they had no way of supporting them beyond that. But life insurance has been around since the Roman Senate. The Roman Senate got together and they decided, if this person dies, then we don't want their family to suffer. So let's all pull in together and let's make this happen. So they'd put a little bit of money together, and when someone died, that money would go to them. It wasn't until actuarial science was able to figure out the risks of life insurance that it became a science. And so about the middle of the 1700s, actuarial science could predict how many people were going to die and when. So they can't say who yet, unless you're from Sicily, okay? But they could say how many people out of 1,000 are going to die this week. And that made it very, very easy for life insurance companies to assume that risk. And so what they did is they started forming these groups, and they were mutual groups, people respecting other people, people with like minds getting together to protect other people. And they would pool their money together, and now they would have, 16, 18, $200 billion that they're playing in bond market with, instead of me maybe having $100,000. And they can take positions that are long and short and mid-range, and they can get an average over a longer period of time, and the time value of money is now working for them. And because they're mutual companies, there are no stockholders. And so who gets the profits from those companies? The policyholders. Okay? And that's why we see here the potential of having over $1 million versus the guarantee that you'll have an additional $548,000. All right? Now, how many have heard that you should buy term and invest the difference? That's been around since A.L. Williams, okay? And A.L. Williams did that because his father was underinsured. And when he died at age 41, it left his family a little stranded. So I can understand what A.L. Williams was doing. However, let's see if that's really true. One of the reasons they'll tell you that, which isn't true, we'll find this out in here in a second, is that term is cheaper. Everyone hear that? You've all heard that term is cheaper, right? Let's see if that's really true, though, okay? Here's a whole life insurance policy for $9,600 a year or $800 a month, all right? And when we get down here to year 15, the cash value that's guaranteed in this policy, legally binding contract guaranteeing you that you will have $132,067 in this policy. If you canceled the policy and walked away from it at that time, that's the money you'd walk away with. What have you paid for it by that time? $115,010. That means that this policy is showing a profit of $17,000 at this point. How much did you pay for your insurance if you've got a profit in it? It's not a trick question. You can say nothing. Okay? You made $17,057 by owning life insurance. Now, let's move on to the next slide, which is a term policy for $500,000. Now, notice what the death benefit is that's guaranteed here in year 15. It's $574,000, year 15. Year 15 and a $500,000 term policy, for first of all, notice the death benefit never goes up. It's always $500,000. That's the way term is sold. At year 15, you have zero cash value in it because term insurance is like renting. You never own. You've paid $4,500 for it, so what is your net gain? And again, this isn't a trick question. You can say, I lost $4,500. Because if you didn't die, which the insurance company was gambling on you wouldn't, and you were gambling that you would, you lost. And they will win almost 99.9% of the time. They have actuarial science behind their contracts. You don't. Is this a bad policy? Absolutely not. I own $2 million worth of term insurance because I want my family to have some more money if I die. But it's not going to make me any money while I'm living. It's not a management tool. It's a risk avoidance tool. I have a 13-year-old son. I would like Michelle not to have to go out and find another job. If I die, we need money to raise our kids, okay? Oops, I went too far. Let's go back to that one. Okay. Now, let's compare that to the whole life insurance policy. In year 15, you had $17,000, right? If you canceled the policy and walked away with it, you had $17,000. What happens in this term policy after year 15? The premium goes from $300 a year to what? $4,800. The following year it goes to $5,200. The following year is $50. Is anyone going to pay those premiums? No. In fact, statistically we know, according to a Penn State study, 99% of term insurance never pays a death benefit. Now, again, that doesn't mean it's bad, but it's not a financial tool. It's a risk tool, risk avoidance tool, all right? And that premium is going to continue to rise until the pain gets so discomfortable, people are going to say, oh, I can't afford it anymore, and they're going to walk away, and they walk away with a total loss. Now, in the whole life insurance policy in year 6, if you choose to continue to pay your premium, your cash value growth in that year over the premium you paid is 86%. Where can you get that kind of annual rate of return on money spent? And that goes up for the rest of your life. That's why we use life insurance, participating whole life insurance, as the second part of your financial tool, because not only does it protect you, it also has a built-in savings feature. You're actually being able to get two things for your same buck spent: protection plus savings, all right? Now, John is really good. My son John, you'll hear from him in just a minute, is excellent at taking people that have unsecured debt, using life insurance to borrow these funds, which we can borrow from this, and paying off unsecured debt and getting them out of debt just as well as any avalanche method or snowball method, and having an asset when you get to the end of it. You see, most people that go through the snowball effect or the avalanche effect to get out of credit card debt, they end up getting there and they don't have anything to show for it except zeros. Well, zero balance is not real building your esteem very much, your ego. And so they do just like people that go on a diet and lose a lot of weight. They go out and binge again, and they get into more credit card debt and more unsecured debt than they had before. But when they go through the financial formula that we teach, they're so excited because they have this asset. And no more than that, they know too that almost from day one, if they died, that debt is paid off. Their spouse or their loved ones don't have to face it because of the death benefit. Now, remember we talked about your risk tolerance earlier on? That's the first thing a typical financial planner has to do when you go see them, is to figure out your risk tolerance. But it's based on some really wacky things. It's based on your age. If you're young, you already have a higher risk tolerance than someone my age, okay? If you have had an unstable income, that means you've jumped around, you're an entrepreneur, you jump here to there, or you jump jobs, your risk tolerance is even higher because you have to make more. And the only way you make more in typical financial planning is to risk more. But risk reward is not really what they talk about. Risk reward doesn't always pay for the risk that you're taking. And so what happens, this is what can happen to a young person. A sensible young person will start saving as much as they can as soon as they can in life, because they realize compound interest is very, very critical. Let's watch what compound interest does to $1,000 a year at 7% Oh, excuse me, we're just doing it at 4% on this slide, okay? So this guy saves $1,000 a year for 15 years. And in year 15, he has $20,000 because he's earning 4% compounding on that. Now, his twin, who didn't save anything for the first 15 years, decides, I better get with the program or I'm not going to have anything to retire on. So he starts saving $1,000 in year 15. And then they save until their retirement age, 47 years later. Who has the most money? Now, this fellow in the green, he stopped saving any money at year 15. He now had to put another dime into this because that $20,000 compounds at 4%, and it grows up to be $70,000 by the time he needs it in retirement. The other fella, he started putting $1,000 in, earning $4,000, and he's got to put it in till 47 for the remainder of the time, 39 years. And so we look at who contributed the most. Who made the most contributions? The guy that started early or the guy that started late? The guy that started late. Now, this could be the same thing as someone starting early in a typical financial plan and losing money and having to start over. Or maybe he dropped down to $10,000. We're not going to end up with as much money down here. He's going to have to save longer to make it up. And so don't let anyone tell you or tell anybody that you know that's young that they're in a high-risk category for investments. That's the most dangerous thing they can do for us, all right? Because you don't make it back up. You've lost time, and time is the most precious commodity that all of us have. The fact is, the fellow in pink here had to save 120% more than the fellow in green. They have 5.74% less than their counterpart, and they had almost 40% less growth. Time is money. You've all heard it. Make your money work 24/7 for you so you don't have to. And one of the best places to prevent you having to start over is life insurance, because it's a legally binding contract that money will be there for you. Now, a lot of people are probably saying, well, man, I'm not young anymore, you know? What do I do? Have I done it all wrong? No. We meet lots of people that have diligently saved in their IRAs and 401ks. Those aren't bad tools, like we said, but they should have come later in their life. But they find themselves down at the end of the road that they didn't have any protection. And now they're going to retire, and they're getting into this, what they call the fixed income phase of their life, and they're worried that they're not going to have enough money to retire on, and rightfully so from the statistics that we've seen. It's not too late. We can still take this savings and we can put it into guaranteed legally binding contracts with life insurance companies that will make sure that you have a guaranteed income for the rest of your life, no matter how long you live, and it will rise at the rate of inflation so that you don't have to worry about this little guy over here that's going to suck up all your money either. Does this make sense? This is what America was built on. Benjamin Franklin, like I said, was the first person that realized the importance of life insurance. Andrew Carnegie said it was the fourth pillar of Americanism. And yet today, it's scorned and laughed at by typical financial planners because they say, oh, you can get such a much higher rate of return. Yes, you can, sometimes. And you're also subject to a whole lot more volatility and vulnerability and the risk of losing it all. Let's talk about one more pillar in this financial formula. A lot of people don't understand that money is a tool. It doesn't measure our wealth. It doesn't make us wealthy. It's how we use it that makes us wealthy and what we use it for. Warren Buffett has stated that it is more critical that you save money than to pay off interest that you owe. Because compound interest is the eighth wonder of the world, according to Einstein. Let's see how that works. Let's say that you borrow $10,000. You're going to pay 5% from it. And I'm using this because this is what you can do from a life insurance policy once you build the cash values. You're going to pay 5% to the insurance company, let's say. You're going to use $10,000. While you do that, your policy is still going to grow just like it was contractually guaranteed to, because you're only using it as collateral. You're not borrowing your own money. The life insurance will loan you money because they have your death benefit as collateral. All right? Over 5 years, that loan will cost you $11,549. So you never borrow money from a policy unless you can make more money. So let's see what it takes to make more money. A lot of people would say, oh, you have to make more than 5%. But is that true? Let's take a look. Earning an annual compounding growth rate on that $10,000 of 3.5% over 5 years will produce $11,880. Is that more money than what you paid for the loan? It is. It's about 5 basis points. What if you can make 4%? Oh, your profits go up. What if you could actually make what you're being charged? Oh my goodness, now you're making over 2%. That's almost what people are paying in their 401k fees, okay? 2% adds up over a long period of time. But what if you could make more than that? Does anyone realize that everyone in this room has the potential to make much more than that? John's going to share with you as soon as I quit talking about how that happens, okay? But before we do that, let's just put everything in perspective. Today, typical financial planners are chasing Wall Street. That's where everything happens for them. But look at this from Forbes. Because we've excessively financialized the U.S. stock market, it's basically costing the gross domestic production of the United States about 2% because of what Wall Street has done to us. And we'll look at a couple other statistics here. And why is the gross domestic product even important to us? Because it's the economy that we are living in. And if we can continue to contribute to that, we just make the situation worse. You know, not only today are people trading on Microsoft stock or Comcast stock or AT&T stock, they're trading on, ETFs of those funds, and they're trading on ETNs of those funds, which don't even own anything. It's just a gamble. And the same thing has happened with currencies. People are trading our currencies and driving the currency war. It's not contributing anything to our economy. It's actually distracting it from it. So that comes out to about $400 billion a year that Wall Street is robbing our economy of. Financial markets in the United States as of 2018 only represented 7.4% of our GDP. So let's look at something else here. Small businesses are the U.S. backbone, or the economy, the U.S. economy's backbone. They represent 99.9% of all the jobs and whatnot that come into this country according to Freedom Partners, okay? U.S. gross domestic product in the market value of goods and services from 1990 to 2018, these small businesses used to have a 50% share in that, and it's dropping. It's dropping largely because of typical financial planning, making everyone focus on Wall Street, okay? At 44%, though, that's still 8.8 trillion instead of 400 billion, all right? Now, a U.S. bank study showed that a whopping 82% of businesses fail because of cash flow issues. And that's what John is going to talk about too, because business is a cash flow demand. You have to have a high cash flow to stay in business and be profitable and to create wealth. And so with that, let's bring up John and let him talk to you about the velocity of money.
We have some worksheets that are blank, and they have a few squares on them and lines, and you'll be able to write in the numbers as we go through this next example. I'm going to draw the same thing right up here, and we'll go through this together. It's an example of using money multiple times. So each of your worksheets are going to have something like this. And we're going to start out in month 0. And this example then is going to go through month 6 to month number 12. And what we're going to look at in this example is the fact that most people save their money or invest their money in places where they can't access it over their entire lifetime. So if we use life insurance as a vehicle to protect and to build our savings, then we can still use those funds for other things in our life, like managing the debt and like making other types of investments that come into our life. What is that potential? That's what we're going to take a little bit of a glimpse at right now. So let's say that you have built up equity of $20,000 over here in this box. And this is going to be with the insurance company, okay? So you can write insurance company right here, write $20,000 in this box right here. Now, the next step, let's say that you have a credit card that's over here, one of the circles on top, that's charging you 17% interest. That'd probably be a good thing to pay off, right? That's going to be managing the bad debt here and getting rid of the bad debt. We can keep the good debt, just like Dad said he would never pay off his mortgage again, but the bad debt we want to get rid of. So you could take this money, you could take a policy loan from the insurance company and move this $20,000 over to this account right here. So you can go ahead and write $20,000 in that. Now, when you do this, the $20,000, you didn't use your money in the policy here. You used the insurance company's money. And so your $20,000 is still growing for you. The policy will continue growing just like you never took the loan as long as you pay the interest. We'll come back to that here in a second. So you take the $20,000 and you move it over here and you pay off your credit card that was at $20,000. So this is gone and now this debt is gone. Does that make sense? Okay. Now, you were making payments to this credit card of $500 a month, let's say. And if you would do that, it would have taken you 5 years to pay off this credit card at 17%. You've paid off the credit card early now. What are you going to do with the $500 a month that you were going to pay the credit card company anyway? Shouldn't you pay back the loan that you took from the life insurance policy? So we're going to do that here. We're going to pay it back to this account right here in the center. We're going to call this account the Money Manager account. I'm just going to abbreviate it MMA. And typically, as we're working with clients, this is a separate personal checking account down at the bank where you do all the rest of your banking. It's a separate checking account because you don't want to get this money mixed up with the money in your everyday personal checking account and accidentally spend it, because that wouldn't be a good thing. So $500 a month. Now we're going to fast forward 6 months. $500 a month times 6, how much are you going to have back in this account at the end of 6 months? $3,000, you're right. $3,000. Now, let's say that you're in business and you have an opportunity to buy a piece of equipment. You can buy it one of two ways. You can either buy it up front. They'll give you a 10% discount on the price of the item, so it'll be $2,700. Or you can buy it over 6 months. They say, you can pay us $500 a month for 6 months. You'll end up paying $3,000 for this piece of equipment. So which option are you going to choose? You have $3,000 sitting here. Doesn't it make sense to go ahead and buy it for $2,700 and save the 10%? So you save 10%, and you take $2,700 of this, and you buy the piece of equipment. Now, if you're going to be honest with yourself, what would you have had to pay for the piece of equipment if you didn't have that money sitting there? $500 a month, right? And so we set up another stream of repayments back here, $500 per month. We no longer have $3,000 here. We still have $300 though, after that $2,700 was paid out. Everyone follow? Good. Now, fast forward 6 more months down the road. We're at month 12 now. You have another $3,000 of payments coming in on the credit card loan. That's going to continue for the next 5 or 4.5 years. And you have another $500 a month for 6 months. That's another $3,000 that came back over the next 6 months. How much is back here in your money manager account? $6,300, exactly, $6,300. Now, we're at the end of the year. The insurance company says, we need interest on the original $20,000 that you borrowed. Your money's still here working, but you used $20,000 of our money. So we need interest on that. Interest on $20,000, let's say it's at 5%. That would be $1,000 that you need to pay back over here. Do you have the money right here? Sure. So now we call this $5,300, and you pay the $1,000 of interest over to the insurance company for another year. Okay? $5,300, what else could you finance? Maybe it's an investment this time. Maybe it's something else in your business. We don't know what this is. This is unique for everybody. Let's say that you wanted to go on vacation now. Everybody likes vacations, right? Okay, could you use this $5,300 to take a vacation? Sure. If you do that, don't you want to pay that back as well? Okay, so you get to set up the repayment plan. You can decide how much interest you're going to pay. I mean, it's just a matter of where you're making the payments. If you didn't make the payments back here, then you would be making them to a credit card that you would put the vacation on, or back to your savings account so you could save up for the next vacation and replenish your savings. It's just a matter of where you're making the payments. So if we set this up over a 2-year period, and let's say you're going to charge 6%, okay, that would be payments of $235 per month. But you haven't made any of those yet because we're still only at month 12. Does that make sense? So now let's add up and see what has happened over these 12 months. We'll just stop in time and take an example. What has happened over these 12 months? What have you been able to accomplish? So down here, you're going to have a money used section on your worksheet. How much money have we used over this period of time? Well, you used the original $20,000 to pay off the credit card. You used another $2,700 to buy the piece of business equipment, right? So we get to add that up over here. And you used $5,300 to go on vacation, right? So we get to add that up over here. What's the total? 28,000, isn't it? What did we start with at the beginning of the year? 20,000. So we started with 20,000 because we were able to use the money multiple times in 1 year. You were able to get the use of 28,000 over the first year. Does that make sense? Now, let's say people say, "Well, you haven't paid that all back yet." That's true. So what have we profited at this point so far? And that's where we need to look at the volume of interest. How much interest have we saved here? And I'm going to pull up the example on this from the credit card. If we take the credit card example, and we amortize the first 12 months of payments on this loan, we have one section that's interest, one that's principal. We can see the balance decreasing throughout the year as we make the $500 payments. We have saved in the first year $3,100 of interest, if we add up everything in this column, on the credit card over the first 12 months. Does that make sense? Okay, you can run that math on a financial calculator, check it all out. $3,188 is what we saved on this loan the first year. What did you save when you bought the business equipment? $300, right? Instead of paying $3,000, we only paid $2,700. So we get to add another $300 here. $3,488 is the number here. But we also had to pay interest, right? $1,000 of interest we had to pay, so we have to subtract that. So we subtract $1,000 of interest. And this leaves us with $2,488 of interest that we have been able to keep instead of paying to others over the first 12 months. If you divide that into the original 20,000 that you started with, that means that you have a 12.44% rate of return on the $20,000 that you started with in the first year. Okay. Now, if you take it all out, and let's say you do nothing else, you just repay the loans just how you would have, you finish out the 5-year period, then the return on the original 20,000, if you figure out all the interest, the additional interest you'd pay in subsequent years, we follow all that out, the return is still 7.04%. if you just take that out. And this does not count the way the life insurance policy has been growing during those 5 years. It's going to perform the same way whether you take the loan or whether you don't. So this is what you're doing outside the policy because you had access to your money. And that's the value of keeping your money in a place where you can use it instead of locking it away beyond your control for the greater part of your lifetime. Does that make sense? Okay. Let's go to the next slide. Drew this all out. I didn't want to throw this up all at once. Okay. But you can take a picture of that then if you want to complete your worksheet. Then when you go home, that's what's happening in this example here. So you can follow all the numbers there. And this is what we help people do, is to keep their money in a place where they can use it over and over again. That's the foundation for everything else that they do financially. Whether they're going to invest after that, whether they're going to put some of the money away where they can't access it always in investments, the protection and the access, that foundation should always come first. And that's the takeaway for today. So I'm going to turn it over to my mom now. She's going to come up and say a few final words.
Did you see a difference between traditional and typical financial planning? Yeah, the traditional, where we have protection, savings, we manage our debt carefully, we consider investments, maybe even black swan investments, rather than doing this type of thing. So people often ask us, well, where do I need to start? You know, Tom showed a couple different illustrations of whole life policies. One was paying several thousand a month. Another one was paying $800 a month. Where do we start? It's kind of like going into a shoe store. You've got to be fitted. Got to see what the size of your foot is and what the purpose is that you have in mind for this pair of shoes. Are you going to go to a dance? Are you a ballet dancer? Are you going rock climbing? Do you want a good pair of walking shoes? We have to fit you, find out what your needs are, and then we can prepare design a policy based on your needs. We want high cash value. We're going to get a death benefit. We want high cash value because your needs for cash are greater than your needs for a death benefit while you're living. So the easiest way to get in contact with us is to call us or to text us. You can text today. This is our number. You can text and say, I would like an appointment. And if you'll also give your name as well, and we can contact you and set up an appointment.